It is now my pleasure to turn today's program over to Dewey Norwood. Please go ahead.
Monique, thank you for that kind introduction, and certainly looking forward to working with you and with Ruth here for today's wonderful webinar. So, scholars, thank you so much for joining us today for our discussion about building responsible credit and specifically why credit matters. If you're just getting started with your credit journey, or whether you've had credit for years and years and years and you're looking at ways to continue to build upon it, I promise you, you are in the right place. I've had an opportunity, team, to take a sneak preview at today's discussion, and it is going to be dynamic, and we are saving tons of time and tons of space to allow you all to submit questions. And so I want to take just a brief moment and walk through our agenda here for the day. You know, certainly October is here, right? We're in October. My goodness, we're just a couple of days away from the month of November. And so many of you scholars have been joining us here throughout the year. So I want to thank you so much for your participation in our Beyond College webinar series. Throughout today, we have a number of links that we're going to be sharing with you. And so please, as those links come in for you, go ahead and bookmark them and then either minimize or close out that page, and then you can certainly come back and reference those things at other times. I'm going to go ahead and share an initial link here for you today for our Beyond College webinar series, so you can access the playback of any of the other webinars that we've done up to this point of the year. So that information will be readily available there for you and should be popping up on your screen momentarily. So here we are in October, leading into November. I really hope, scholars, that everyone is continuing to stay safe, staying physically distanced where you need to. I know that lots of you may be doing this semester from home or doing it from the other side of the country, maybe away from your campus or from your university. So please, please, please do everything you can to stay safe, stay physically distanced where you need to, but also stay close to your homework. Stay close to that calculus work. Stay close to those office hours for your professors. Stay close to those friends from a virtual perspective for the gospel choir and for sports teams and intramurals and the drama club. Stay connected in those areas while you can. Also want to thank so many of you all actually submitted applications for our Student Impact Scholarship. Again, with that hashtag you see on the screen there for our Impact Makers. Congratulations to all of the scholars that submitted applications there. We are literally weeks away from announcing those awards. And so to any and everyone that submitted an application, thank you so much for getting those submitted. And we're very close to making those announcements. So special shout out to our great partners in the marketing world of our firm and others across the firm that added a lot of great value to that program. Certainly want to spend a couple of minutes talking about kind of the things that are coming up next here and some important items to consider. So what's today about? You know, we're certainly going to be doing some assessments about where you stand right now relative to your own personal credit. You know, are there some stabilization activities that need to be happening? Are there any adjustments, candidly, that you may need to make in one area or another? And then also, what can we do to be resilient during the pandemic and even after the pandemic? What are some things and best practices that we need to be keeping in mind? So these are some of the topics that we'll talk about. And we're also going to answer your questions. Scholars, I want to thank you all so much for the questions that were submitted in advance. We received a number of really, really good questions, and our distinguished panel is going to have an opportunity to integrate some of those things in as they go through the presentation with things here for today. And then when we get to next steps, we'll certainly share some resources with you and give you some reminders. I can go ahead and let you know now we're very excited. The webinar series is coming back again in 2021. We're going to be moving to a brand new platform, actually delivering those through Microsoft Teams. So we'll be sharing more information. And in the weeks ahead, we'll also have a flyer giving you the dates and times for all of our 2021 presentations. Last but not least, don't forget, get social with us. Go ahead and use that hashtag WFC Beyond College. You can hashtag WFC Beyond College. You can share that with any and everyone that may be interested in listening to the playback of any of these sessions and really, really getting what we think is some great information. Hey, I want to give a quick reminder here to go ahead and submit any of your questions that you may have throughout the course of today's presentation. Again, remember, scholars, this time is really for you. And so we really want to make sure that we're giving you good information, but go ahead and submit those questions to us, and then in turn this will be a good way for us to continue the conversation with things. All right, as promised, there's some additional links that we're going to push over here to you. I'll go ahead and push the next one now. And this is actually a press release that came out just yesterday, and it's focused actually on retirement. And scholars, I know you say, well, wow, it's going to be a long time before I retire. But I think there's so many interesting pieces that came from this piece. And you'll see this is actually from our great partners within our WIM, or Wealth and Investment Management team. And they talk about kind of the sentiment now, especially around the younger generations, as you all are thinking about retirement and long term. So just one of the quotes in there talks about, Gen Z and how you all are having to start saving at an earlier age, and the importance of getting involved in employer-based programs and places where you can have matching in other kinds of areas. And so also just a lot of discussion about how the landscape of retirement has changed as a result of the pandemic. So I would just encourage you to take a look at that link and share that information with others that you think may benefit from it as well. Final reminders here, go ahead and submit those questions to us. Use that Q&A feature. I already see one question that's come in, so scholars, thanks for submitting those, and just keep those coming in throughout the course of today's conversation. And remember, those questions come in to us confidentially. We're never going to read your name. We're never going to give you rank or serial number when you submit a question, but I promise you, scholars, if a question is top of mind for you, I promise you there are other scholars that probably have that same question. So go ahead and submit those for us, and then in turn we'll do our best to address them either directly via email with a note coming back to you, or throughout the course of today's presentation. With that said, I quickly want to hand the reins over to a great trusted partner of ours, Bonnie Wallace, who actually is a financial health professional within our philanthropy group, now known as Social Impact and Sustainability. A great partner of ours. You can certainly go ahead and get connected in with Bonnie via LinkedIn. We'll share her profile in a moment, as well as the profiles for other panelists. So go ahead and reach out to them to kind of continue the conversation. And Bonnie, I hope that you're having a beautiful day there in upstate New York. I want to give you some metrics as we kick things off here. We actually have over 200 students that have registered to be a part of today's discussion. Our wonderful higher education partners at the Hispanic Scholarship Fund and the Thurgood Marshall College Fund have referred the most students to today's presentation. And Bonnie, I got to shout out the universities that are at the top of the list. The University of Nebraska at Omaha actually referred the most number of students. Yeah, they referred the most number of students here. And then one of our wonderful HBCUs, North Carolina A&T up in the Greensboro area, actually finished in second place with the most registrations. So special thanks to Andrea Valena for pulling that data for us. And Bonnie, we want to give you the reins here for the next phase of our discussion. I think this is session number 9 for us, if I'm not mistaken. Have we been working together that long?
It's been a long time, Dewey. It feels even longer than that.
It feels longer. Well, listen, I'm excited to hand the reins over to you. Listen, we need to work together, and we're doing good work. This is good trouble, right? We're getting into good trouble with the things that we do.
Exactly.
So, Bonnie, we'll give you the reins from here, my friend.
Thank you, Dewey, so much. And I want to also give a little shout-out to North Carolina A&T. We've got the Student Ambassador Program there that is available through a partnership we have with SFE and PD, the Society for Financial Education and Professional Development. So if we have any of our student ambassadors there that are providing financial education through to their peers on that campus, I just want to give them a hello. If you're on the line, maybe shoot me a note. I'd love to hear from you. So Dewey, I want to say these are unprecedented times, which has been said over and over and over again. I think we said it back in April and May when we were doing these together. I think
we did.
It's getting old. But what I can say is that, this pandemic, it's just really killing us, right? It has spurred the most rapid deterioration of our economic environment in modern history. And it's likely to continue, and it's likely to continue to affect our personal and our household finances for years to come. And so as we see this contraction turn into really a longer-term economic recession, it's likely that we're going to see high unemployment rates, tighter credit standards, increasing debt loads. So it's really a wake-up call. So even if you're feeling pretty stable right now, I need you to kind of really take a step back, listen today, keep your eyes wide open, your ears wide open, because this is really a harsh reminder of how important it is that we're not only financially stable or financially healthy, but we're actually financially resilient. So today what we're going to focus on is, first of all, just understanding where you are, understanding your current state, taking an objective view of where you stand financially. The second thing we're going to focus on is stabilizing your finances, so making sure that you're secure and adjusting your financial plans. And the third piece is rebuilding with a focus on resiliency. Because if it can happen now, even if we get on the other side of this, something is likely to happen in your future. So we really have to kind of shift to this mindset of financial resiliency. We've got 3 guests with us today. I'm going to introduce them. I'm going to actually ask them to introduce themselves so you don't have to listen to me talk and talk. But first I'd like to introduce Christian Bonner, and he's a colleague of mine and Dewey's at Wells Fargo. Christian, can you share a bit about yourself, including let us know where you grew up, where you went to school, your path to Wells Fargo, and what your current role is?
Hello, everybody. I'm Christian Bonner. I grew up in Cincinnati, Ohio, and I'm from Ohio, and I went to college at The Ohio State University, and I currently work as a relationship manager in commercial banking here in Atlanta, Georgia. I've worked all over the country for the bank in St. Louis, Washington, D.C., San Francisco, and now here in Atlanta. And that's a little bit about me. Did I cover all my bases, Bonnie?
You did. Christian, what do you do for fun?
Yes, for fun, I love to bowl. I love to run. I love to listen to classical music and a little bit of R&B. And I also enjoy real estate as a hobby as well.
Awesome. And then Dewey, talk about getting into good trouble together. You and Christian have been having some time, right?
We have. We just came off of some programming with our national partners at the Thurgood Marshall College Fund for their Leadership Institute, and we had Christian. Christian, did you do 3 sessions or 4 sessions? I have to remember. I think it was at least 3.
I did 3 sessions total.
So, I had to write a lot of checks because Christian Bonner does not come cheap, y'all. And you heard him say it. He's from the Ohio State. We're going to see what his Buckeyes do this weekend now that they finally got football back going. But we're going to leave that topic for another day, Bonnie, and for another day, Christian.
They'll be fine.
All right.
We'll leave it. Okay.
I think they'll be fine.
So, next, I'd like to welcome Lauren Kennedy. She's also from Wells Fargo. And for those of you who have previously attended the webinar series, you may remember Lauren as she's a credit expert, and she's really got a strong passion around sharing her knowledge and experience with credit. So if you've got tough kind of technical credit questions, Lauren is the one to answer them. So Lauren, if you could share a bit about yourself as well.
Okay, so I have to dig deep and remember, but I do recall I went to college at Emory University in Atlanta, so I might know your stomping grounds over there, Christian. And I love to bowl too, so I love to take you on in a match one day after those bowling alleys open back up. And my degree was in math and economics, and then that led me to migrate my way up to Charlotte, North Carolina, where I currently reside, working for Wells Fargo. I've been with the company for I've been in the industry for over 20 years, most of that time spent with the company. And yes, most of my time's been spent in consumer lending, working in credit risk. So this is really developing strategies behind the scenes that's going to determine who's approved or who's declined for a credit product, setting things like credit limits on credit cards, setting interest rates. All of those components are very impacted by a person's credit risk profile. So I'm very passionate about that and would love to answer any of your questions. Really would like to share today more of the lender perspective with you. So as all of you are, thinking about your own financial decisions, you can have that different lens. How would a lender perceive this action that I'm about to take? Would this be a good thing, a bad thing? And build that into your decision-making process. Back to you, Bonnie.
Thank you, Lauren. Last, I'm really pleased to introduce Bruce Mcclary, and he's from the National Foundation for Credit Counseling. And you'll hear us refer to that as NFCC. So Bruce is a much sought-after speaker and educator, and we have been in the midst of, what I'll call kind of like a conference season, and Bruce is either leading sessions or moderating sessions or a lead panelist on a session. So we are so fortunate to have him here with us today. He did warn us that he's feeling pretty good right now, but his voice might get a little scratchy by the end. I'm going to turn it over to you, Bruce, and let you introduce yourself.
Well, thank you very much, Bonnie, and it's certainly a pleasure to be here and to be a part of this group. I think I'm amongst some very highly qualified, highly talented, and skilled panelists. I'll try to keep up as I can, but I think if I'm having to think all the way back to where I grew up and where I went to school, you're starting with hard questions already. I grew up in Central Virginia in a small town called Appomattox. You may know it from the history books because it's where the Civil War ended. And I went to college at Old Dominion University, go Big Blue. So that's a little bit about where I grew up and where I went to school. And as far as the work that I do today, I'm the Senior Vice President of Communications for the National Foundation for Credit Counseling, the NFCC, as we'll refer to it later. I came to the NFCC in 1998, and I started as a counselor and worked directly with consumers to help them through financial issues related to debt repayment, to building a budget, to savings. And prior to that, I worked in the lending and debt collection industry, so I have a lot of direct experience on the lending side. And having worked as a debt collector, I often advise people based on my knowledge of what goes on behind the scenes with debt collections. So hopefully today I can add value across a range of different topics that relate to building credit, maintaining good credit, remaining financially stable, and planning for the future, also dealing with student loan debt specifically. So I'm happy to be a part of the panel. Thanks for having me.
Bruce, thank you so much. And I just want to kind of share, too, that while the title of this webinar is really focused on credit, we're taking a few liberties, and we're going to broaden the discussion to include some other aspects of financial wellness. You know, we're now in, I think, the 8th month of this pandemic, and again, as I said, we're looking forward to many more months of economic stress. So we're encouraging you all to take a hard look at your financial situation, to work on ensuring financial stability, and then begin building that resiliency. So said a little differently, we not only need to make sure that we're prepared for today, we really need to prepare for an uncertain tomorrow as well. I want to acknowledge, too, that I'm seeing questions come in already. Thank you so much, and we are definitely going to get to those questions, and I encourage you to keep going. So keep loading up that Q&A box. So the impact on an individual's finances really varies. I'm sure you may know this among your family or your friends. Some are really struggling, while others seem to be faring just fine because their situations haven't really changed, or they've got ample wealth or emergency savings. And others have been kind of kept afloat by some of the programs that came out from, like, the CARES Act. But I want to take a minute just to do kind of a pulse check with the audience. So take a look at this and let us know where you fit. What statement best describes how you feel about your current and future financial situation? The first option is you're stable but a little worried about the future. The second is, I'm in a great position, and I'm sure that I can weather continued economic stress. Or the third is, I'm hurting. I've used and nearly exhausted all my resources and options for delaying or payment of my debt. I need help. Which one reflects how you're feeling? Got about 20 seconds left. Dewey, can you see early indications?
Yeah, I'm taking a look here. It looks like we're getting some responses in, Bonnie. We're going to give it another couple of seconds here because it looks like some folks are still responding. Okay, they're continuing to build here. We're going to give it just a moment.
I have to tell
you,
that, answering this question may vary on the time of day sometimes.
Well, which is interesting, right? So, Bonnie, let's take a look here. Wow, okay. I'm seeing a very even spread here. Looks like we are slightly above 50%, knocking at the door a little bit, almost 60% here now for question one, and that number is continuing to jump. Decent, let's call it maybe a quarter of folks saying number two, that they're in a great position financially. and they feel like they can continue to weather some economic challenges. And then also, Bonnie, there's a percentage of folks here that are just saying very candidly, hey, listen, I've exhausted the resources that are at my disposal. Now having to get into some situations where I'm having to balance through even some of the debt that I had, and candidly are asking for some help today. So, wow, very interesting. And scholars, thank you all for sharing very candidly with that. I think this will help us to lead the conversation in the right kind of a way.
It certainly will. And, we do have information and resources for everyone, right? So for those, especially for those who are saying, I really need some help, please do not hesitate to reach out to us individually. We'll try and address some of your questions through the webinar, but we have resources for you that you can work with one-on-one that can really help with your specific situation. So please don't hesitate to reach out. Now, it's encouraging to learn that many of our audience are really doing well. And while we look at the economy right now, the unemployment rate is high, but if you look at some of the macro indicators of financial health, like things like average Fico scores at a national level, those really haven't dropped that much yet. Average debt levels they haven't increased that much, right? So it's almost puzzling because you look and you say, well, I know people are hurting, but why are we seeing some of these macro financial health indicators still looking pretty good? So, Bruce, how do you explain the dichotomy here? Why are so many people really not yet feeling the full impact of the pandemic, specifically, job losses, higher costs for goods and services, ballooning debt?
Yeah, Bonnie, this has been puzzling to some people because you're right. There is that very stark difference, that dichotomy that exists. And to be honest, I think if we just step back a minute and look at the bigger picture, the pandemic has had an uneven impact on all aspects of the economy. It's left some industries largely unscathed, while others, like airlines and hotels, just for a couple of clear examples, those industries have been devastated. There have been tens of thousands of layoffs, people without income, people struggling to make ends meet. So, that's one piece of this that we have to keep in mind. So there are people out there who are still fully employed and have benefited from the fact that their work situation has moved to a remote environment, and they no longer have the costs of commuting, of transit, of all the things that are associated with getting to and from work. In a big city like where I work in D.C., you have to pay an arm and a leg for parking. So all that money is going right back into savings. And there are other ways people in those situations are saving as well, because they're not traveling as much or at all for recreation. So thousands and thousands of dollars for some people are being saved because they're not traveling as much this year. So that's the good end. Those are the people that are doing very well and don't have many cares in the world right now. And then you've got the other folks who've been sideswiped with these layoffs. And just from our own data, we have a survey that we issue each year. It's the Consumer Financial Literacy Survey. That survey is available when we release it at nfcc.org. It's really telling about where people are financially. And we've seen that a lot of people just don't have a lot of money set aside in personal savings to weather these emergencies. That's one of the points I'll bring up occasionally as we go through this discussion of how important that is. And last year we saw when the federal furloughs took place, people ran out of personal savings in 2 weeks. They were scrambling to try to find a lifeline. Well, the same things happened here, but lifelines are being used still. And that's the point that I think I want to make here, is that it leaves us with some of the false indicators that are directly related to those who are otherwise in a very bad place. And when I talk about false indicators, I mean false indicators of financial stability, like people taking advantage of rental eviction moratoriums while their past due balance on rent owed continues to build and build into the thousands and thousands of dollars. Eventually, they're going to have to pay that back. That's a problem. We also have people who are taking advantage, many student loan borrowers are taking advantage of the payment relief that's in place until the end of the year on federal student loans. That's a good thing. I'm glad that's in place. But if the financial circumstances of those people haven't improved by the end of the year when those run out, that's a bad thing. And those people I would put in the category of not being in a very financially stable place, even though if you look at on paper, all the measurables. Are their accounts being paid up to date? Are they not falling behind in certain areas? Those seem to look okay on the surface, but you look beneath the surface and it's not okay. And the same is true on the consumer debt side with credit cards and loans. Distressed consumers are still using account restructuring or temporary hardship programs, or even playing the old balance transfer juggling game as long as they can while their credit score is good to keep things afloat. And that's eventually that's going to play out to a pretty bad conclusion if people's financial circumstances don't get better on the back end with income and savings.
Yeah, Bruce. And for those that are feeling really good about where they are, please understand we want you to feel good about where you are, right? But at the same time, just really hear what Bruce was saying, which is don't have a false sense of security. We really got to kind of peel back a couple layers to understand, not only what's happening today, but what's coming. So if you're on one of those deferrals, if you have been getting some sort of assistance, and if that has the potential of running out in the next couple of months, you've got to really kind of adjust your plan to look at those things. But we know that some people are really doing well, and they're kind of the picture of financial health and financial resiliency. And Christian, I'm going to point this one towards you because I think you might be kind of in this place of, what are some of the characteristics of someone who has been faring really well during this economic recession? Christian, you might be on mute.
Yes, I'm sorry. I was getting off of mute there. My apologies.
No worries.
The good old mute. The good old mute. We love mute.
I lost a little bit of connectivity at my at-home network. Can you do me a favor and repeat the question for me?
I sure could. So Bruce was just sharing that while there's, we have a lot of reason to believe that there should be a negative impact of this economic recession related to the pandemic, many people haven't felt it yet, and we haven't seen it with some of the macro financial indicators related to things like debt levels and Fico scores. And what I'm also interested in understanding is kind of, for those people that are faring very well, what are those characteristics of someone who is really financially healthy and financially resilient? What is it that they're doing that it's helping them weather the storm?
Yes. So are you referring to maybe the credit standards that might have changed because of the COVID environment when it comes to maybe borrowing, for example?
No, just more specifically, what are some characteristics of someone who's financially stable and financially healthy? And for example, one of the keys that they say is that you should have emergency savings. And in the past, we've said you should have 3 months of emergency savings. We're now looking at this current situation and saying, maybe 6 months, maybe 9 months, maybe a year is better. So what are some other characteristics of someone who's financially healthy that you're aware of, or things that you look at for yourself?
Yeah, absolutely. So I'll first start with all of my bills and utilities, for example. So I'm a relatively new homeowner, and when the pandemic hit back in March, I know that there were a lot of advertisements on television in regards to contacting your providers for your services, whether it be cell phone, gas, electric, water, and seeing if there's any opportunities for discounts or for your bill to be lowered, or say, hey, I work for this company, you have a special rate for us, things like that. I will also say that, groceries always defeat, dining out, and can save you a boatload of money there. So I would say a little bit more careful budgeting from month to month on how much groceries can get you through 30 days versus dining out, how you might be able to save money in that facet. And then lastly, again, I would also say that, something as simple as car insurance. I know if you were with State Farm, they were proactively offering their customers discounts because folks weren't driving as much during the pandemic. So it just didn't hurt to maybe ask, to see what exists out there to maybe find you a better discount. And then also cell phone bills. There's also a lot of hidden fees there. Call in and say, hey, am I on the most competitive plan? What can be removed? What could I do without? So just kind of reviewing your bills and seeing where you might be able to save and make cuts. That's what I would say a lot of financial savvy people have done during the pandemic.
Thank you, Christian. So, as I think about what Bruce has been sharing, which is really, it's easy to get a false sense of security right now because of all of the support that's been available, like the payment deferrals. And, you're talking about making some changes to your spending habits, as an example, and to your saving habits. I'm feeling like a little unsettled. So, Bruce, you've got extensive experience as a financial counselor. What do you look at? So when you're working with someone and trying to assess their financial well-being, both currently and in the future, how do you objectively assess their personal finances, their personal habits? How can you tell if they're prepared for an unpredictable future?
Yeah, that's a great question. And, thinking back to when I was a counselor and working directly with people, I would see all kinds of different circumstances. And when you come in and talk to a nonprofit credit counselor, the first part of the process is to conduct a full financial overview, a complete review of your financial circumstances. And it's very detailed, and it's focused on a number of things, but there are really a few elements that you can focus on. I think if you're going to do your own temperature check and see where you stand financially, first there are three big things: savings, savings, and savings. All kidding aside, but savings is critical, and that's always at the top of my list. You can't really build on anything if you don't have a solid financial foundation, and it is very important, it's critically important to prioritize savings. No matter what your financial circumstances may be, as long as you're earning $1 of income, a portion of that dollar, you should try to move over to savings, and you should start as early as possible in life, and you should continue as long as you can during your working years to not only set aside savings for emergencies, but setting like that emergency savings that you alluded to, Bonnie, about the 6 months or more, but also saving for retirement at a time in your life when you're going to need that money the most. It's very critical. So I always look at that to start and see where people are with savings and building their foundation. And then in terms of the here and now part of this, I think a good rule to use is the 50-30-20 rule. And if you've heard of this, bear with me for a minute. If you haven't heard of this, I'll explain it just briefly. It's really just kind of a simple back-of-the-napkin budgeting rule of thumb that helps you make regular decisions about what to spend and how to manage your money without making it overly complicated. A lot of people say you should budget and you should budget regularly, and there are some people that want you to track every single penny, which is, I think, what turns a lot of people off to the budgeting process. So the 50-30-20 rule simplifies that. And it basically says that you should spend half of your income, 50%, on the basics, the essential needs, food, shelter, those kind of things. And then 30% you can spend on the things you like to do or you want to do to give you a little bit of joy in life. And then the 20% is for savings, keeping it at 20% regularly. And if you stick to that rule, you're ahead of most Americans, because most Americans do not put aside 20% of their income for savings. So you're already winning with that. And then the last component that I want to mention is how you manage your debt. A key to success here is really debt management. So it's challenging when you already have a significant amount of debt, and when you come out of college, you're already carrying student loan debt, and you probably don't have a lot of savings set aside. So you're already working against a strong countercurrent in trying to build that foundation and pay down your debt. So it's already challenging out of the gate, but it's very important to prioritize when thinking about the big picture. Focus on why and how to borrow and when. Scrutinize offers for credit cards, loans, and mortgages and see how they'll fit into your overall budget and how you can sustain those, keep those up to date, protect your credit while also keeping your other obligations on track. And then if you approach all of that in a very thoughtful and strategic way, then you're putting yourself in a good position. So I would absolutely say savings, debt management, and then keeping up with your budget and sticking to the 50-30-20 rule so that you have very clear financial goals and you know at least generally how you're going to accomplish those and that you're working towards those.
Bruce, for the audience, I think if you take nothing else from this time together, then that you're going to be well served, right? So just to repeat it, the first one is savings. As Bruce said, savings, savings, savings. That's the foundation for your financial health. The second thing you talked about was the here and now and really paying attention to your spending plan or budget with this 50-30-20 rule, which I think is awesome and it's easy, right? It's easy to remember. 50% on kind of your basics, 30% on your wants, 20% on your savings, and then really be diligent about managing your debt. So it's not to say that you shouldn't use credit or have debt. It's that you have to be super diligent about it and responsible. So Bruce, that is awesome. I want to focus a little bit on credit, and we've got Lauren on the line. And one of the most common indicators referenced related to financial health is your credit score. So if you're paying attention to what's on TV, what's in a lot of the publications, it's FICO score, FICO score, FICO score. So, my question for you is how effective is a credit score in indicating your financial health? What does it really tell us, and what does it tell others, specifically lenders, about your financial health?
Yeah, thanks, Bonnie. And I'll just start by giving a quick description of what the FICO score is. I think I saw one question, what is the FICO score? So the FICO score, that is a proprietary algorithm that was developed by a company called Fair Isaacs, and that takes into account all the information on your credit bureau. So there's three major credit bureau companies. There's Equifax, Experian, and TransUnion. And lenders are, constantly sending information to these three credit bureaus. They're reporting things like, oh, I just got an application from Jeff Smith, and that'll show up as an inquiry on the credit bureau. If you have a credit card with a lender, they will typically report how you're paying on that credit card to the credit bureau every single month. What's the balance on that credit card? What's the limit? Are you current? Are you past due? Those types of things. And then the credit bureaus, all that data that's at the credit bureau is going to feed into this algorithm and produce a score, one number that's supposed to be representative of really how you're doing managing your debt. And so it's just one number, so it's really just a directional indicator. Even though there's a lot of focus on the FICO score, it's something that all lenders are familiar with. Generally, all lenders get that score. They use it. All of the credit bureaus use that same algorithm, so it's very well known. But again, it's just one number. And so what I would say about the score is if you have a low score, that's really going to hinder your chances of getting approved for credit. However, if you have a good score, a moderate score, that's just the first step. That's just the first thing that the lender is going to look at. It just sort of gets your foot in the door, and then they're going to look at other things, more detailed information that's in your credit bureau. Things like how much credit do you have? Do you have what they would call a SIC file where you have a lot of credit, a lot of different trades? What's the diversity of those trades? Is it all credit cards? Is it all unsecured revolving debt? Or do you have things like an auto loan or even a mortgage where it's secured debt? The more diversity you have, the better that's going to look. Although, again, a lot of those things will take time to build, right? It can take time to work up to a mortgage or even to need a mortgage. They're going to look at how long is your credit history. Have you only been using credit for 6 to 12 months? That's going to be a thin file. And so one thing we see with the FICO score is consumers could have a thin file, just one or two trades. Maybe they don't have a very long credit history. It's only 12 months. And they have a credit score. They have a FICO score. And it could be a really good score because maybe this person is using their credit card responsibly. But a lender still might not view that very favorably. They might view that as, you don't have much credit. I don't want to take a chance on you. So there's a lot of things that go into it. A couple of other factors that the lender is going to look at is what's your utilization rate on your unsecured trade lines? So again, things like credit cards. Are you maxed out on your credit card, or are you highly utilized? Are you using up most of your credit limit every month? If you're high up in that utilization range, that's generally going to hurt your FICO score, and it's also a factor that other lenders are going to look at, and it's not going to be viewed favorably. So you want to try to keep that utilization range down in the lower range, certainly under 60%, 50%. So yeah, FICO is just one number, I think is how I'd sum it up.
Okay, so I just want to make sure that I understand that, help our audience understand. So the FICO score, right, or your credit score, whether it's the FICO, which is this proprietary score that is highly used, right, kind of highly leveraged by lenders, whether it's that score or another one, your credit score is really kind of a snapshot of a point in time that's reflecting what you've done in the past, right? How well you've made your payments, how much debt that you have, right? Things. So it's kind of reflecting the past. So it's not necessarily a great indicator of. It's an indicator of future performance if everything else was the same. Is that how I could kind of think about it? With all things stayed the same, it's probably a good indicator of future performance.
Yeah, and it's actually designed to predict future performance. That's how the algorithm is built. But I will mention that there are several things that the FICO score does not take into account that's not generally available in credit bureaus, things like your income. Usually a lender will ask you, what's your income? And that's going to be part of their credit decision, and that's not going to be in the FICO score directly. Savings, how much is your savings? That's not going to be included. Things like, are you paying utilities? So if you have a cell phone and you're paying that every month, you're generally not going to get credit for that on your credit bureau report, which feeds into the FICO score. However, if you don't pay your cell phone bill and you eventually have that go to collections, that could show up and be reported to the credit bureau as a negative mark. But you're right, Bonnie. Although it's based on your past history on the credit bureau, it's designed to be predicting how we think you're going to perform in the future, and that's why it's then used in lending decisions. And I will say it is constantly refreshed. So as like I said, lenders are constantly sending updated information to the credit bureaus, and so that score is constantly being refreshed to take into account that additional information.
So what I'm aware of and what I'm hearing you say is that as a lender, if you were trying to make a decision about whether or not to give someone a credit card or whether or not to give someone a loan for a car, you would look at their FICO score, and that would be one thing that you'd look at, right? You'd also look at their income and how long they've been working. You might look at their savings. You might look at other elements of their credit report. So you're trying to get a full picture of who they are. So that's one part. But now, like, given the situation we're in right now where there's so much instability and so much unpredictability, are lenders apt to kind of change what they're doing or how they're thinking about things given the uncertain future?
Yeah, absolutely. Generally speaking, lenders are tightening up given the high uncertainty, as well as some learnings from the past recession. So the Great Recession that came about in 06, 07, 08, 09, what we learned from that recession and what we observed in that recession was that the FICO score really wasn't as predictive as it had been. And so FICO score was really overvaluing consumers. So, if you had a 700 score during the recession, that really performed more like a 660, for example. It wasn't as good performance overall. And so lenders are now taking that into consideration as we're into this pandemic, right? And they're generally tightening up because we would expect maybe something similar, that the FICO score doesn't hold up as well during a recession. And then when you couple that with the other things that I think Bruce was talking about, and you were talking about at the beginning of the call, where there's a lot of stimulus money that's been put out into the economy. There's a lot of forbearance and deferral programs also that lenders are offering where customers aren't making their payments, and it's really hard to ascertain, or much harder to ascertain, what's the consumer's financial picture from looking at their FICO score. It doesn't tell us as much as it used to. So lenders are probably going to rely on it even less, and lenders are going to be also tightening their standards. So, for example, in the past, if you had a 700 and that was enough to get you approved, you might not be approvable today for the same credit product. In addition to that, lenders might actually ask you for additional information. They might ask you for proof of income, right, because there's more concern around people being employed and having steady income. Things like your debt-to-income ratio. In the past, maybe a 50% ratio was acceptable in some cases, and now that might not be good enough, and you might get declined. I mean, those are just a couple of examples, but those are the kinds of things where lenders are going to be tightening up their standards or have been tightening up their standards, and all else equal, it's going to be harder to get credit now than it was pre-pandemic.
All right, and this, I just want to kind of emphasize too, this kind of sticks with the theme from the earlier part of the discussion, which is, you've got to be really kind of astute right now what these indicators are of financial health, that even in the best of times, your credit score, your FICO score, is just one piece or one part of the financial health picture. In today's environment, it's more important than ever that you're not only focusing on your credit score, but you're focusing on savings, income, and debt management as well.
And Bonnie, if I could, this is Bruce, if I could just dovetail a little bit off of some of Lauren's comments about the FICO score. I want to make it very clear to everybody who's listening and everybody who's tuned in today that there's a very important distinction that you have to make when you're looking at your credit score, and an understanding and perspective that you have to put into that. The credit score that you are looking at, if you're using one of these popular apps that you can download that will give you your credit score, it's very important to know what score they're showing you, because it may not be the same score, that the lender will use to make a decision about whether they're going to approve you for a loan or line of credit. So the score can be a guidepost for you in those situations if you're just using what comes off of the app. But when when you're talking to a lender, when you're applying for credit, if you really want clarity on what they're using as a benchmark, ask questions about what credit score they're pulling, what they're looking at. Then you know that the one you looked at on your app, whatever you downloaded, is close to what they're going to be seeing. But don't get your pants in a bunch if you hear from them that they pulled a different score than what you saw on your app. It's not the end of the world. It's just that there may be two different varieties of score that are in play here.
So for our panel, we're getting a lot of questions about credit, and I want to really be sensitive to the needs of the audience. So I want to take a pause kind of from where we had planned and maybe just address some of these questions. So the first question, and maybe I can give this one to Bruce. Bruce, is a FICO score the same as a credit score?
It is a credit score. So yes, it is one of the different credit scores out there. And I don't want to overcomplicate things for everybody, but I would just say that FICO is probably the most widely used credit score and widely referenced credit score when it comes to just general lending and access to credit. There are other scores out there. There's Vantage Score. There are different versions of the FICO score. And I don't think you need to get mired down into all of those details, but yes, the FICO score is commonly referred to as a credit score, but there are other versions of credit scores that are out there, and even proprietary scores that many of the lenders use behind the scenes that are variations on the FICO or the Vantage. So I guess that's a complex answer to a very simple question.
And then just as long as I've got you, Bruce, how do you recommend that people check their FICO score?
Well, it's interesting because now we live in an age where people are basically just sticking it in your face. Every time you log into your account with whomever you bank with, you see your FICO score. You go to a soda vending machine and you can probably get it there too. But it's always good to go to one of the big three credit reporting agencies, Experian, TransUnion, or Equifax, to get a copy of your score as well and to see what comes along with your credit report. And there's a distinction here though, because you also want to look at the details of your credit report. So if you want to look at the details, you can do it for free. And you can go to Annualcreditreport.com. That's Annualcreditreport.com, and it's a website that was created in cooperation with the three credit reporting agencies, and it gives you free access to your credit report, normally on an annual basis, because the name says Annualcreditreport.com. But during the coronavirus pandemic, they've changed it up a little bit. And you can now go to that website and get a free copy of your credit report from each of the three major credit reporting agencies on a weekly basis. So the main reason for that is so people could get more regular access to their credit to ensure that some of the payment deferment programs that they qualified for are reporting correctly and they're not being penalized for it. So that provision, I believe, runs until April of next year, then it'll revert back to once every 12 months free access.
Yeah, and we just dropped that in, so you should be able to see that, bookmark that link. You should be looking at your annual credit report more often than annually, right? So oftentimes, too, depending on who you bank with, they may be able to give you access to this, also give you score updates. And we'll share at the very end, Wells Fargo has a financial education program. It's free, and it's called Hands-On Banking. We'll provide some information on that at the end in our resource section. But there's information at handsonbanking.org on how to read your credit report as well. And so looking at that credit report, you'll be able to identify if there's anything that's incorrect. And there's instructions on handsonbanking.org on how to correct those items that are incorrect. And that could have a big impact on your score.
And if I could jump in again just to raise a point that you just brought up about how to read your credit report, understanding what's in there, and then if there are any errors, reporting them quickly. Errors can negatively impact your credit score, so you want to make sure you're addressing and correcting inaccurate information as quickly as possible. And one thing I would warn people about is that you want to be careful. This is a thing that you can do yourself for free. And there are a lot of credit repair scams out there that are trying to lure people, promising to clean up credit and fix things instantly. I would be very leery of any offers from people who are promising you those things for a fee in advance. It's better to go through the steps, take your time, and with assistance from educational tools like what was mentioned with the hands-on banking and the tools that are available at Wells Fargo, or you can go to nfcc.org and talk to a credit counselor, and they can walk you through it at no cost. It's better to do it that way than to get ripped off and end up with your credit still needing attention.
Yeah, incredibly important point. And, Christian, I'm going to put you on the spot here. And you're still, college is still relatively fresh in your memory. The rest of us had a really hard time kind of going back that far. How did you go about building credit?
Absolutely. I'm so glad you asked me this question. So I'll tell everybody my personal testimony of where I began. And it actually began before no, I take that back. It began when I was 18. It wasn't before I was 18, because before 18 you have to have a cosigner. So technically you need to be 18 to apply for a credit card. And I did that. And when I went to go apply for your typical Visa credit card, I was declined because I didn't have bad credit or good credit. I had no credit. So because of that, when I went back home that following summer break after my freshman year of college, I went to my local credit union in my hometown of Cincinnati, Ohio, General Electric. And they were one of the few financial intermediaries in the area that still did what you call a secured credit card. And that's when you make a deposit with the credit union, for example, in the amount of $500. You leave it in an account there, and that whatever you have in that account there is your credit card balance. So it's a secured credit card because it's secured by your deposit. And you must leave that balance there to maintain that level of a limit. Anything you withdraw will, of course, reduce your balance. So I used that for my entire duration of college, my sophomore and junior year. And by the time my senior year came around, I was able to apply and be approved for unsecured credit cards with relatively high interest rates. So I held on to those cards for about 1 year throughout my senior year, and then a little bit during my first year out of college, showed good colors, made payments on time, didn't carry over large balances from month to month. And by the time I was 2 years, 3 years out of college, somewhere around there, I was able to get a typical competitive credit card. And, eventually I made my way to American Express, but that wasn't until years later. So that's what I would share with you as far as going about building credit. Look for a credit union in your local area or online. There's several financial intermediaries out there. The secured credit card is not as common as it was a couple of decades ago, but I was able to get it just 1 decade ago.
Thanks, Christian. And, as we were talking about, as Lauren was sharing, it's probably more difficult now, even than it was 6 months ago, to get credit if you don't have it right now, right? So if you don't have credit and you're trying to establish it, Lauren, I'll kind of, are you aware of maybe some other ways to start establishing credit if you currently don't have it and it's tough to get, maybe a regular credit card, Kristen suggested a secured card, which is a great solution because it's easier to get, but not maybe as available as it used to be. What are some other ways you can establish credit?
Yeah, and that's, I am glad you mentioned the secured card because sometimes that's overlooked. I mean, a couple other things you could try. One would be a private label card with a store retailer. So, you go and you get a card from, say, Best Buy, right? So sometimes they have, they're more willing to give a low limit credit card to a new borrower. Certainly you could get a credit card with a cosigner, like a parent, if they were willing to sign on to that. And as long as you're a cosigner, you really want to be a cosigner or a co-applicant, not an authorized user, because being a co-applicant means you have joint responsibility for that product, and you should be then reported to the credit bureau. Sometimes if you're an authorized user, you're not going to have that show up on your credit reports. It's not really going to help you establish credit. And then the other one that you might want to consider is if you already have a banking relationship, you already have a checking account with a bank, and you've been using your checking account responsibly, meaning you're not overdrafting, often those banks are more likely to lend to you and give you a credit card, especially if they have a student or a college credit card product. They often have a product like that designed to go hand in hand with someone who's in college who already has a checking account relationship with them. Bruce, do you have any other suggestions on how to establish credit?
Yeah, I think I'm glad you brought up the secured card because you're right. It is something that often gets overlooked, and I think it's your foot in the door. And I think when you're talking about establishing credit, the other thing to do is set your expectations. If you're starting with a thin file or no file and you go and apply for a starter card, there are also special credit cards that are available for students, student credit cards. Shop competitively and look for the best rates and the best deals. But be prepared to face the fact that you're not going to get the absolute best rates that are available on the open market for everybody because you are starting out. So your interest rate is probably going to be a little bit higher than you may like. But this is a process of graduating from your starter at some point after you establish credit to a better, more affordable, more competitive credit product, or even working with the credit card issuer that you started with to modify that card so it conforms to where you are on your journey in building your credit score and your financial situation. So I think that's important to remember. I think back when I opened up my first card, I was right out of college and I went to a retail department store. And, they gave me the application at the counter. I filled it out, and boom, all of a sudden I had a credit card. And it did get my foot in the door. And, again, it was something that I graduated from. I didn't use it a lot. But I think once you get your foot in the door, you use that responsibly, then you're able to move to that next better credit product that's more affordable and gives you more of what you want.
So has anyone on the call gotten in any trouble with a credit card, maybe in your early days?
Yes, and I'm happy to share this humiliating, embarrassing story, if that's okay.
Please.
Yeah. So it was around that same time when I was just out of college that I was working, odd jobs through the summer, and I was trying to make ends meet. I was paying student loan debt. I was doing all of these things, and after I got the retail card, I got an offer for a real credit card, a Visa credit card from my bank, and I applied for that card, and I, without realizing it, I started using that credit card a little more than I should, and I started bumping the balance up closer and closer to the credit limit, which was relatively low. It was a starter card. And I wasn't really thinking about how close I was getting to the credit limit. And I was making minimum payments, but I was spending more than I was paying. And I ended up going over the credit limit. And when you do that, you get penalized. And they can shut the account down. They can charge you a penalty interest rate that's way higher than what you got when you open the card. And then, of course, if you fall behind on your payments, even worse in terms of the impact on your credit. Ultimately, I wasn't able to get that under control, and the account closed down, and I had to aggressively pay off the balance and start over. And that was a massive blow to my credit score. What I started with that department store card was all completely destroyed with what I did with that Visa card, and I had to rebuild my credit from scratch. And it took a while, more than a year or two, but I was able to regain a decent credit score after time. But it was not something that I really needed to deal with at that stage when I was trying to pay off student loan debt and meet basic expenses, and then know that I was knocked back to the bottom of the stack on the credit score scale, and also dealing with some past due debt that I should have been more responsible about.
Yeah, I think, Bruce, we all have a similar story, right? A humiliating story we could share about how we kind of went sideways with credit. And so it's evidence that it's pretty easy to do, to kind of get in over your head with a credit card or with other kinds of debt. So Lauren, what are some of the good things that you should do? So if you do get a credit card, you start working to establish your credit, what are the things that you can do to help build your credit, increase your score?
Yeah, I mean, first of all, you do want to use the credit card. Don't just have it be inactive or dormant. But, don't max out the limit. Don't do what Bruce did. Again, you want to keep that utilization rate, probably around 50% or lower if you can. If you can pay it off every month, that's great. But as long as you're making at least the minimum payment, right, then you're going to be reported as current to the credit bureau. That's the main thing there, is keeping utilization down, making your monthly payments on time. And then, after you've done that for maybe 12 months, then you might want to look at getting another credit product. And you're probably going to have to get another credit card, most likely. But you may be able to get something like an auto loan, after having a relatively short amount of time or thin amount of trade lines on your bureau, and things like, if you were looking for an auto loan, things like having a large down payment, a considerable portion of the amount, having that in a down payment, that can help you get qualified for something like an auto loan. So those are the main things you want to do.
So
yeah,
Lauren,
I'm sorry, one thing I just wanted to add to that, in terms of, you were talking about the credit utilization ratio, Lauren, and I know that it's important. What's most important, and yes, what Lauren said is absolutely correct. You want to keep a low utilization ratio. I usually recommend 30% or lower, so that's no more than 30% of the balance overall available line of credit on your credit card should be used up with your balance. But it's also important to make sure that you're able to manage payments under that scenario, because if it's not sustainable for you to affordably make timely payments with that amount of your balance used up and owing that amount, then you should probably adjust and make sure your balance is even lower than that, because you want to make sure it stays in the affordable range, because one single missed payment on a credit card, especially if it's the only thing you've got reporting to your credit report other than student loans, that can set you back significantly with your credit score if it starts reporting that you're missing payments. So just keep that in mind.
And so Lauren and Bruce, you both mentioned this term utilization. Lauren, in just really simple terms, can you explain what you mean by utilization?
Yeah, I think Bruce mentioned it, but basically you take your balance, your credit card balance, and divide it by your credit card limit. So if your limit's $1,000, right, that's the max you can spend at any one time before you make another payment. If your balance is $500, then your utilization is 50%. So that's the ratio
right.
we're talking about, keeping under 30%.
Yeah,
and obviously, as you're making purchases, that rate is increasing over the month, and then you make a payment and you can bring it back down. And I will mention, you can make more than one payment a month. So especially if you have a low credit limit, it doesn't take much to get up above the 50% utilization range. But if you want to keep using that and have the utility of that credit card, you can go in and make multiple payments. Go make a purchase and go make a payment. That's one way, especially if you're getting like rewards points or something and you want to use that card a lot, just make extra payments.
And I saw a question coming in on the side that I don't want to ignore, because somebody asked this, and I think it has to do with utilization, but it's a little bit of a different angle on this. They're asking if after graduating, should you close old student credit cards and get new and better ones? Closing a line of credit that you have that's active, even after you pay off the balance, et cetera, can have a temporary negative impact on your credit score. And the primary reason, if you think about your utilization ratio, your combined utilization ratio across all of your different credit card accounts is a factor here. So if you shut down an account, it brings your overall credit limit down closer to the remaining balances you owe. And that can have, again, it's a temporary negative impact on your credit, especially if you're maintaining your other accounts as you're supposed to, and you're responsibly opening new lines of credit as needed. That's something that you can recover from, but it's certainly a consideration if you're thinking about how you're going to be maintaining your accounts post-graduation.
So there's also been a lot of questions around, making decisions around, how do I take the money that's coming in? Do I use it to pay down debt? Do I use it for savings? Like, how do I make those decisions? And several references to kind of this 50-30-20 rule. And, what we said we would talk about, too, is this whole idea of, like, how do you adjust your financial plan for this environment? And, Dewey, I'd like to bring up this question around budgeting or having a spending plan.
Absolutely. The polling question, right?
Yep, bring that polling question up. So, we've
coming up as we speak, my friend.
We're talking about credit, and just to kind of make this connection, you really need to understand what you can afford to spend, whether you're spending cash or using it on a credit card. And the way that you're going to be able to understand that is by having what some call a budget, what others call a spending plan. So I want to get a sense from our audience, do you have, and more importantly, do you use a budget or a spending plan? And your options are absolutely, not only do I use it, I update it regularly, I do not, is another option. Or the third one is kind of, I've made one, but I could do a better job of using it. So let us know where you stand on having a budget.
All right, Bonnie, the responses are coming in as we speak, and panel, fascinating discussion thus far. Really, really enjoying kind of where we're heading with things. All right, and let's see, Bonnie, so we've got some early indications here. Okay, definitely have some folks that are falling into the absolutely category, saying they've got it and use it. We do have some folks that are falling into the I do not have one category. So scholars, thanks for answering candidly there. And then a lot of condos. In a nutshell, it exists, but maybe not so much. And they could maybe do a better job of managing it. So scholars, thanks for the real responses there. Interesting breakouts here, Bonnie. Very, very interesting. Lion's share that were coming in with answer 3, the kind of.
Right, which I would expect, right? And I would put myself in that category, kind of. And Christian, I put you on the spot before. I'm going to put you on the spot again. Do you have a budget or a spending plan? Do you actually keep a budget? And how has it been working out, if you do? How's it been working out over the last several months?
Absolutely, yes. I would say that I do keep a budget. And it has worked out very good for me the last couple of months. I go into my, I live off of my credit card for the points, pay it off with cash each month, full disclaimer. I go in and I check my monthly spending on each of the categories. And ever since the pandemic hit in March, I'm totally down on shopping, outdoor dining, entertainment, movie theaters, X, Y, and Z. So that significantly helps my budget. Of course, I allocate so much to, dining out versus eating at home. I have so many days a week that I prefer to prepare a meal at home, and then so many days a week that I prefer to dine out. That helps me stay on budget. And also, you want to have a leisure budget, just a little bit of, cash allocated, for, a movie theater or the skating rink or the bowling alley, if you would. That's also very important that you have a little bit set aside for that. And then you also, you have all your mandatory expenses, which come out first. And I would say that setting a budget has been very helpful. And, of course, this year it's been a bit more easier to maintain a budget because there's so little going on outside of our homes.
So Christian, it sounds like your spending's down. What have you done with the money that you're not spending?
I've saved it. Yep, I've simply put it aside and saved it, and maybe at some point next year I might be able to invest some of it, somehow. But I've essentially found a way to save more effectively this year. So I guess I'm kind of thankful that I have been inside in some ways. It's been a great, great time to save. Yeah.
Wonderful, perfect. Just the answer I was looking for. So, and you, I would put you in one of those categories. You just said you've been fortunate. You're thankful. We do have people in our audience who are in that position, right? Their spending's down. They've been able to increase their savings. But we know that we've also got a large percentage who are really struggling, really even just to make ends meet, and that they could have, when they put their budget together, or if they've had it and they go back and kind of refresh it, they may find that they've got more money going out than coming in. And so, Bruce, what options are available today if you can't meet your obligations, if you do in fact have more money going out than coming in? What should you do?
Yeah, I think it's important at that point to reach out and get help. You shouldn't feel like you have to struggle through this alone, and sometimes when you have to go and face a broken budget, it's something that adds more stress to the situation. It's already bad enough that you're feeling the financial pressure and that you've got more money going out than coming in, and you can sit down with your budget for hours, but when you're down in the trenches and you're in the fog of war, duking it out with your budget, it's always good to get reinforcement. So there is help out there. I recommend that you consider talking to a nonprofit credit counselor, and again, my own organization, nfcc.org. It's a nonprofit organization. The counseling sessions are free. You can reach out through the nfcc.org website and connect with a counselor who can walk you through a budget session to help you sort things out and look at all of the things that are touched by your budget and all the priority obligations and help you make sense out of it. But it's also important to use the help that's out there that can help you restructure the debt and some of the other obligations that you have. We were just talking about during the coronavirus pandemic how a lot of lenders, a lot of creditors, a lot of utility companies still have programs in place as lifelines to get people through difficult times. Those that are still available, use them. How do you know which ones are still available? Call everyone you owe and have a conversation with them. Talk to them about what you need, talk to them about your situation, and ask questions. What options are available? I was asked the other day about by a reporter about how many of the major creditors are offering these special pandemic hardship programs. And, roughly out of the top 10 creditors, which represent about 70% of the credit card market, about half of them are still offering the special skip-a-payment programs that were offered back in April. But it doesn't mean that options are off the table. You can still call, you can talk to your credit card company, you can talk to your lender, and find out what they can do to meet you halfway, to get you through a difficult time if it's a temporary situation while you get back on your feet. But I think the main thing here is to understand that there is help available. And, it sounds goofy, but I don't know if this probably isn't someone that's recognizable to this generation, but Mr. Rogers, everybody remembers Mr. Rogers. He used to tell kids, if you're in trouble, look for the helpers, look for the people who are there to help you. Well, it's the same thing when you're an adult. Look for the helpers, look for the people who are out there to provide help. And nonprofit organizations are there that provide free budget and credit counseling. Your lenders are there to help too. They want to make sure that you're okay as well. Just make sure that you're open to communicate, you're open to share, and that you're proactive, and then you can get through those difficult times.
Bruce, I'll add to that. This is Dewey, and say any day spent with this panel is a beautiful day in the neighborhood.
That's
again.
Like
none of the young people get that at all, Bruce. But you and me, man, we're seeing eye to eye.
I get it. There's one more resource I want to mention too. That if you do reach out to NFCC and you don't want to go into a counseling session, but you just have a question, there's a page there, and it's up in front of you right now. I see that page was shared, but it's the Ask an Expert page. And if you just have a quick question about managing your budget or credit or whatever the case may be, I'm joined with a number of other subject matter experts on student loans and credit card debt and budgeting and savings that can help you with some of the basic questions. So don't hesitate to reach out there as well.
Yeah, thank you, Bruce and Dewey. And again, to the audience, the resources that Bruce is talking about, there's a reason that we've got Bruce on the line today for this audience, is because we're trying to connect experts with people who need help. And you don't have to be in trouble. You don't have to be in that category of, that in the beginning where we said, I'm really struggling, I need help. You don't have to be in that category to get help or to benefit from help. Bruce, can you just share a little bit about what someone who's actually in a really stable place right now, how they could benefit from financial counseling?
Well, you're never, I always say that it's like the professors that would never give an A. You're never at that perfect point. Even if you think your budget is working and all the wheels are turning and you've got this finely tuned financial machine, I think you should always be open to other advice, and you should always be open to try new things and use different strategies in managing your budget. And I'm that way myself. I give advice, that's my job, but I'm always turning to other experts, my colleagues, other people in the field, to ask them what's working for them. What do you do differently than what I'm advising people to do? Should I consider doing something to manage my budget and to manage my finances differently? You can always learn and improve in this process, and you should never get to the point where you think that the thing you're doing now that's working so well for you is going to be the thing that works well for you tomorrow. Things change, circumstances shift, and you always need to be prepared to adjust, to improve, to learn. Thanks,
Bruce. And, we're getting kind of close to the end of our time together, and I want to just kind of recap a little bit. So, we talked about initially just really assessing where you are, and I want to make sure that everybody takes a step back, looks at their financial situation. If you don't have a budget, create one. If you do have a budget, update it. Really look at what's coming in and what's going out. If you have an opportunity to reduce some of your spending, if you're spending on things that are, kind of categorized more as wants than needs, look at the opportunity to reduce some of that. And if I was with you, I would ask the question, I'll ask it of Christian, why do we want to reduce our spending? What can we do with that money?
We can save and invest.
Save and invest, right? So that savings is going to help create that financial resiliency, right? That's going to make that cushion for you so that should something happen in the future that you aren't prepared for, you've got that nest egg, you've got that savings to sit on, right? So we know that budget's going to help you see that. Bruce talked about it, the 50-30-20 rule, savings, savings, savings. And the 50-30-20 is 50% of your spending should go to your basics, the things that you need to have done, 30% to wants, 20% to savings, and then also the importance of managing your debt, making those payments on time, and keeping your debt levels as low as possible. And when you do all of those things, right, you manage your debt appropriately, you're going to have healthy credit as well. And so then we talked a lot, too, about what credit is, what your score is, what it indicates, and how you establish credit and how you build credit and how you get that healthy credit standing or healthy credit score. We've covered a lot of the questions that have been submitted. There's a bunch that we haven't that we will be able to get to you, Dewey, right? If we answer them offline, we'll be able to push them out to the attendees?
Absolutely. Those are sitting in the queue. So when we respond to those scholars, those that will actually come to you all directly. And Bonnie, while I've got the mic here for a brief moment, there's two things that I want to do as we're heading to close here over your next couple of minutes and certainly getting some follow-ups from our distinguished panel. I want to go ahead and send over our survey. So team, you're going to see this popping across for you. This is simply our survey for you to give us feedback on today's webinar. Still got a good number of folks that are logged in with us. Please keep in mind, in some instances, this may be blocked and may not show up on your respective web portal. That's okay. You can certainly give us feedback offline relative to that. So team, that's coming right across for you. Hey, Bonnie, there's a term that's come up a couple of times here. I've heard Bruce and others mention, free credit counseling, Does that also mean that there are other credit resources that are quote unquote pay to play? I'll use that term around them. And do we need to be careful at looking at paid resources versus free. Just spend 30 seconds on that, and Bruce, certainly chime in as well from your perspective.
Yeah, I think the thing I would say is, yes, there are resources that you can pay for. If you want to go to a certified financial planner, for example, or an investment advisor who is properly credentialed and certified, I think that's a good use of your money. If you really want to kick your financial well-being into high gear, that's certainly a good resource. But I think there are some questionable resources out there, and it's you know, sometimes it's tough to know what to look for. But oftentimes the scams are aimed at people who can least afford to be ripped off, and those are the people in financial crisis. And you'll hear a lot of these debt relief companies promise to make your debt disappear magically, or you know, they can guarantee negotiate away all the debt you owe to your creditor, and they'll take a lot of fees from you, and you may not get much in return. Those are the ones that I would say, you know, the ones that are running the ads that you see on TV all the time, et cetera. Just be leery of those and be very cautious about that. But if there is free advice available, that's always a good place to start. You can't lose anything by taking time to get help there. And then if you want to move on and talk to somebody else that you have to pay, just make sure they're properly credentialed and that you're getting the best deal.
Wow.
Thank you,
Bruce, thanks for that.
Super important.
Thanks for that.
And, you know, as we're wrapping up, I wanted to give each of the panelists a few minutes just to kind of share their wisdom and experience with the audience. I'm going to start with Christian. You know, Christian, what can you share with our audience in terms of advice around building their financial health, building their financial resiliency, and really trying to prepare for a continued economic recession for at least the next 6 months or so? Christian might be on mute again.
Hello?
Are you there?
Yes, I am. I can hear you now.
Okay, so Christian, just asking, what are some final words that you have for the audience in terms of, you know, your advice or direction and how, you know, knowing where they are, that they're either in college probably or newly graduated, might even have some people in high school. You know, what can they do now? What's your advice to them now to make sure that they're financially healthy and that they're building financial resiliency?
Sure. I would say that, you know, don't take out too much debt. You know, you have a long life ahead of you. You don't want to be in a predicament where you're trying to rebuild a credit score from a low point. You know, you want to start with a fresh slate. So don't bite off more than you can chew just because there's so much access to credit out there, which I've heard of folks doing before, and then they end up with this pile and they don't know how to clean it up. So I would say don't be too aggressive in taking out too much credit in your first decade, or I guess that would be, or in your 20s, so to speak, because again, you have a long lifetime ahead of you, and credit can be pretty powerful when you go to that retailer, you know, want a charge card. If you go over to that car dealership and you want a brand new vehicle without a cosigner, or you want that beautiful new home down the street, you know, that's a very, very powerful score. That may seem so little, but it tells a big story about you and your history and how responsible of a borrower you are. And my apologies for the connectivity. Thank you all so much for bearing with me this afternoon.
I think that's all part of our resiliency, right? We're all working from home and going to school from home and trying to deal with this. So, yeah, we need to have another session just on, I think, mental health, Dewey.
And resilience.
There's not. There we go. We balance through. So, Christian, great
Lauren,
information there.
Lauren, 30 seconds.
Real quick. I'd say be strategic. So, I mean, just like anything you want to accomplish in life, any goals you have, you want to be strategic about building and diversifying your credit profile. Do it slowly but stably, so that when you get to the point in your life when you do want, you know, to buy a car or to have a mortgage, you've built up that good, strong credit history, and you'll be in a good position to do that.
Thank you, Lauren. And Bruce.
Yeah, I would say this. Every setback is an opportunity. make sure that when your debt is high and you don't have a lot of money on hand, you do have one resource that's available plenty, and that's communication. Don't hesitate to reach out for help. Don't hesitate to communicate with all the people that you owe. And if you're in good shape financially, use that to your advantage and communicate there as well. You always have the power to negotiate, and don't be afraid to use it. Because any failure to reach out and try to find a better deal to save more money is really where you're failing yourself more than anyone else.
Thank you, Bruce. Love that. And again, we are resources for you as well. So you've got our information. If you want to reach out individually, we're happy to help. And there's some other resources here. We mentioned the Annualcreditreport.com. This is incredibly important for you to look at your credit report and make sure that everything on that is accurate. Again, you can use multiple sources to learn how to read that credit report, but take a look at that. Do it multiple times a year. The next one, Dewey? Mentioned hands-on.
Good old hands-on banking.
Good old hands-on banking.
Yep.
That one comes up on most of our webinars. So again, this is a public service provided by Wells Fargo. It is entirely free. There is no branding. You're not going to see any products or services mentioned on there. This is purely financial education and information. I encourage you to take a look at that. It's available in both English and Spanish. I think there's another page there, Dewey. You can just kind of
you do.
Yeah, just kind of move past that one. There's all kinds of information on this site. It's incredibly rich with information. There's another organization that provides free financial counseling. If you can go back one, and that's AFCPE. They actually train and educate accredited financial counselors. This is another resource for you. There's links here. It's something that Wells Fargo, we partner with AFCPE to make free financial counseling available to people across the country. And then we've mentioned NFCC several times, and that is where Bruce is from. These are both organizations that we are highly reputable, highly effective, and free. So please take advantage of both of those, NFCC and AFCPE.
Well, Bonnie, thank you. I want to acknowledge the great job that you did here walking through a ton of questions that came in. And so thank you for your great leadership, my friend. 25 years in the industry, y'all, for Bonnie Wallace. So please make sure that you connect in with her on LinkedIn and continue the conversation. And, of course, Christian Lauren from the Wells Fargo perspective, virtual high five to you all. Just another flawless delivery of our hashtag #OneWellsFargo approach around the way we do things. And so thank you so much. And Bruce, my goodness, man, I think I'm going to invite you to Thanksgiving dinner and to multiple events, man. Family reunion. We're going to put you on the, you know, you're speaking already, man. We're going to put you to work. I mean, just so many jewels and nuggets with what you all shared for today. So just thank you all so much for some really great information. So again, scholars, go ahead and reach out to, you're welcome. Go ahead and make sure you connect in with all of our great partners on LinkedIn to continue the conversation. Hey, over our last couple of minutes here, just want to remind you, we got 11 done. We got 11 webinars done for the year. We got one left that's coming up literally 2 weeks from today, and it's all about digital natives and social media smarts. We always like to end with a fun one, and this is one that we really enjoy every year. And so go ahead and get pre-registered for this one. And we're going to have a really direct conversation about social media, some of the good, some of the bad. We're going to talk about deep fakes. We're going to talk about all kinds of things relative to social media. So come join us to be a part of that one. You know, as a reminder, we will be sending back the playback details for today's webinar, so you can access the playback really about 72 hours from now. You'll actually utilize the same link as you used today to access the playback. And again, go ahead and use that hashtag WFC Beyond College. Again, hashtag WFC Beyond College to share the information with anyone else that may not have had a chance to join today. Just such rich information. You will be prompted to log in a password. I never say it, but that password is there on the screen and will be included in some of the follow-up communications that we'll be sending out. So please utilize that password, and then boom, that will let you right into the session to access playback. And scholars, please remember, playback will be available for any of these sessions until November the 30th. That's a little bit of a change here for this year. But any of the sessions playback will be available between now and November the 30th. And so we mentioned this one a little bit earlier. Just going to re-push this link one final time for the survey information. So please go ahead and take a minute, give us feedback. We're always looking at ways where we can improve our processes. So we'll just send that link one final time there. And again, our apologies if that's blocked for you on your respective servers, but you can also just go ahead and send us out an email if you have any questions or comments relative to today's presentation. So we've covered a lot of items here for today, and again, we're really excited about our next webinar that will be coming up with us next month, my goodness, for November, on the topic of social media smart. So just special thanks to all of our partners today for all of the great information that was shared. I'm going to send two final links as we close things out. Certainly don't want you all to, or want to make sure that you all know how to catch up with me, so we've pushed my LinkedIn information there as well. And then the final link is one I think that's going to be really of interest to us. Again, as we're getting into November, many on the phones today may have already gone out to vote, but we are in election season. And so we just encourage you to take just a fast look at a great news story that the firm has put together about the importance of voting. Lots of great resources that are listed here, so please make sure that you're taking a look at this and just seeing and just knowing that your vote matters and it's important. I would encourage you to do a lot of research so you're making sure you're making great decisions as you approach the ballot box, and then ultimately determining where you'd like to cast your vote. It is your vote. It's something that you own. Please use that and celebrate that right and privilege that so many have fought for us to be able to have. So just take a look at that. And again, certainly share that information with others as well. With that said, I certainly want to, again, thank all of our panelists. Again, also want to celebrate Andrea Valena, who's working in the background, helping us with a lot of great things. Andrea, thanks a million for your help. And Monique and Ruth, thank you all so much for facilitating a really, really great call. We'll give you all the reins here to close us out from here.
And thanks to all our participants for joining us today. Please take a moment to complete the survey. It should appear on your screen momentarily. We hope you found this webcast presentation informative. This concludes our webcast, and you may now disconnect. Have a wonderful day.